Sunil, great as always to have you. First of all, we've had the Fed, outcome last night. Of course, he held on to rates that was in line with consensus. In terms of the dot plot, they've stuck to the two rate cut that they had earlier indicated. But for 2026, they have scaled it down to one. I mean, nobody knows what will happen from here in terms of U.S. action. With respect to Iran, Israel, and also in terms of what impact tariffs will have on inflation. How are you looking at the commentary, and what do you make of the scaling down of the rate cut to one for 2026?
I think that's a very positive sign because it means that the Fed doesn't see that they need to do too much to make the economy revive. I think these two rate cuts are a recognition of the fact that some kind of slowdown will occur due to the tariff related uncertainty. But they feel that with just one more rate cut next year, the economy should bounce back. So I would read this as a positive signal that they don't see the US slipping into a long recession because of this. And I think that's because the China deal has more or less been signed, the UK deal with US has been signed, and Trump also indicated yesterday that he's going to sign a deal with India. So I think that the fact that Trump is bringing all of this to a conclusion and maybe by Christmas, so that's a difficult end of the year. So uncertainty will probably lead to a slowdown in the current context. But if you look at it, he's charged what 755% tariffs with China. So overall, I think that his expectation that it will not pass on to too much inflation is also reinforced by the Fed saying they'll do two rate cuts. Because clearly, compared to the 130, 140% numbers that he's talked about, they've come down much more. So if you take that, an average of let's say 15 to 20% tariffs will, right? Those 15 to 20% are something which is can be absorbed by the intermediaries of the US companies which are importing on the chain. And the income actually goes to the US government, right? The tariff income. So to that extent, I think that inflationary pressures are not seen to be as threatening to that extent. So I would say that from that context, right, I would read this Fed situation. Naturally, the Fed always reports, I mean, responds to data on the ground rather than to any stated strategic direction. Okay, so you should take that with a pinch of salt because at every point in time, the fresh data will make them change the dot plot and change the stance. But as things stands today, the fact they're talking about two rate cuts later means they're supportive. But at the same time, only one more rate cut next year means that they don't see that Fed needs to do too much to make the economy bounce back from a, I don't say recession, but from a slowdown.
All right, got your point on that. But let's talk about the market. We have been fairly okay. As I was pointing out, 24,800. We've been able to manage this level here, pretty okay, smartly, in fact, over the last few days. Here on, would you say that there isn't much downside because we've digested pretty much everything very smartly?
Well, I would say largely true. I'll tell you where the downside will be if the US steps into the war. And then when the does that then all US installations all over are subject to attack by Iran. And the fact that that might tip Iran's hand into doing something strong on the Hormuz Strait transportation, right? See, so far they have laid off from that. But if that happens, I see oil spiking further in the short run. So I would say that by and large, it's what you're saying is true. But I think Trump's also making noises about that he might go to war. I think he came back early from the G7 summit. His statements seem to indicate that the US wants to up the ante, which is not good news from the fact that then, it's not a reconciliation with Iran. He's trying to threaten Iran into, signing a deal, which I don't see that Iran will respond to. So barring that, if America actually lays off and uses this just as the saber rattling, right, and not actual action, what do you say? I agree with you that Indian market has absorbed probably the worst in the current prices, barring that development, which we need to keenly track over the next. On the contrary, right, I would say that uh, leaving that aside, the Indian markets are actually now poised to benefit from a positive up move, either of the war settling down and oil price retracing back, because it's entirely this oil shock that has caused this the price to rise, the war shock. So if there is an easing there, actually it could mean positive for Indian economy if the oil retraces back to the mid 60s. That's one.
Hmm.
Second is of course the BTA signing. Again, as I
Sure.
point out, Trump talked to it saying I'm going to sign a deal with India. That will be a huge positive booster to the markets because a lot of the tariff related sectors are still having the overhang of uncertainty. And their valuations are the one where there is space because market participants are still hesitant to commit to saying that India will win this war in the tariff BTA but lose that war, right? There's still uncertainty of which we will win and which we will lose. And it's wrong to think that we will win every battle on the tariff front, right? So, to be fair, that uncertainty overhang is still there. And when that gets clarity, right, in signing of the BTA, some good, some bad, markets will then seek to touch new highs. And that's where FII flows might again come back and support the market. So far as domestic liquidity, which is holding this market at the levels that is currently seen.
Sure, got your point, Sunil. But let's talk sectors then. For consumer durables like AC, for instance, uh,
Hmm.
of course, there will be a hit on volumes due to early arrival of monsoon. So, how does really one approach these AC players now? Because we all know that there'll be more disposable income in the hands of consumers post the tax cuts that were announced in budget. Then there was the rate cuts as well that came in from RBI. So all in all, there'll be more disposable income in the hands of consumers. But given the fact that there is a headwind, how would you approach the AC makers?
So I think that, see, the big season for them is almost over, which is April, May, June, right? And we are now ending the end of June. So I think that in the rainy months, right, obviously the kind of durables you mentioned, air conditioners, water coolers, are not going to drive this. It'll probably be some other consumer discretionary items, right? So as far as these numbers are concerned, some of that is already in the price because the summer was fairly hot. I think Delhi saw very record high temperatures. So I would see that I would expect the numbers when they get displayed. So July 10th, when the earnings season starts, it'll give you a sense on whether the heat wave actually led to those greater sales, right? But you're right that with the oncoming monsoon coming through, those demands are not likely to sustain, except to some extent of a festival season bonus related buying. So I would still say that some people will still wait for
Hmm.
a you know Ganesh Chaturthi or a Diwali bonus to make those durable purchases. So I would still have some hope for some kind of a sales pickup around that. But I would take the attention away from just durables to a broader consumer discretionary space of
Hmm.
auto reality. So
Hmm.
the liquidity that you mentioned hands of consumers with the rate cut pass on. I think now the situation is right for a transmission of the rate cut. With liquidity supportive, RBI also having done a massive rate cut. So the long end of the borrowing is where the leverage is the maximum, right? A small drop in EMI means that you can probably put another 25 or 30 lakhs into a bigger house. So I think that that's where I would see the real things come through in terms of the market, that the broader discretionary space will benefit. And within durables, yes, the cooling related durables, obviously their best season is now coming to an end.
Hmm. What about jewelry makers, likes of Titan, even the other names like Senco, Thangamile, Gadgil, recent listing? Gold is of course back in focus amid safe haven rush, and if this Iran-Israel conflict escalates further, there's no sign of de-escalation. All we all know, and once US joins this fight, will gold prices head higher from here? And if that happens, will demand get impacted? Rising prices, and in that sense, how should you look at those jewelry makers?
So, yes, I do think that gold will continue to rise. I mean, no, it went up about 25-28% over the last year, but don't expect the same kind of rally, but definitely double-digit growth in gold prices. And it's not just the continuing uncertainty. The Fed's rate cut, two rate cuts, will lead to pressure on the dollar. When the dollar is under pressure, gold is a natural alternative. And I think I read a lot of reports saying that central bankers are all looking to increase their gold reserves in the coming year. So all of this is a positive for gold prices. Now, what is the impact of gold prices? Yes, to some extent, it will hurt people's buying because the jewelry, when people see these prices rising, they like to postpone their purchases. But bear in mind, a significant proportion
Hmm.
of this happens with trading old gold jewelry, right? So what happens there is that then that comes in as sales for these companies that you mentioned in the gold space, is that their business will get, because at these times when price rise, people say, okay, let me take my old gold, old jewelry, which is out of fashion, maybe bought years ago, and trade it in for new. So you'd see sales pick up there coming from a traded jewelry. One. Two is that all of these companies hold inventory of gold. So to that extent, from a valuations perspective, their stock of gold rises in that valuation. And to that extent, their working capital limits, if they need to borrow from a bank, you have a higher value of gold to pledge to get the money. So that's again a
Hmm.
positive for them, because all of them have been buying gold continuously to stock to make jewelry over this period. So I think overall, that's why it's a positive sign. And in India, no, if it's a wedding season, festival season, gold purchases, Diwali for Dhanteras or a wedding, you're not going to stop that just because gold prices are high. So a certain amount of core demand which comes from
Hmm.
an event like a Dhanteras or like a wedding, that will continue. It's only at the margin that, a fashion jewelry or something, you would think a little bit. Like I said, but trading old gold will again come in and substitute a part of it. So overall, I remain reasonably positive on the jewelry side, because they are also part of the discretionary retail, right? Which is where the higher disposable incomes will get deployed. I would say that that's something that will also help the gold demand from retail.
Okay, at the margin you may see some impact, but the demand, over the long term should remain intact despite rising prices. That's the takeaway. But let's talk about the recent shift in expiry days, right? Most brokerages, in fact, street feels that the volume and market share pain that BSE will see maybe short term in nature, and over the long term, BSE will manage to regain market share, especially due to the long term contract liquidity and the common contract note that allows traders to trade both in the FNO and cash market. So, do you concur with that view? Do you think that shift in expiry day to Thursday won't be such a big setback for BSE, at least over the longer term?
Yes, I concur with that view. These are short-term readjustments that will happen, but in the longer run, I don't think that that matters. I concur with the view that you spelled out just now.
Sure. Last question really. We had the SEBI board meeting yesterday, a lot of key takeaways, but I want to know your thoughts on particularly the move to allow liquid and overnight fund units for mandatory deposits, changing fund flows meaningfully. Could this nudge greater flows into these categories?
Yes, absolutely. And I think SEBI wants to divert them, because these are lower risk products than even the regular liquid funds, right? Because regular funds have a 30-day time frame, but these are overnight are far less risky, and they'll improve liquidity at the very short term. So I think that this is a big booster for that category. And it's good for the industry to
Hmm.
diversify it across these spaces, because the short-term liquidity that the RBI is doing essentially plays out through these categories in the mutual fund industry. So the transmission of the liquidity
Okay.
measures of
One
RBI.
last.
Yeah, sorry, go ahead.
Sure, go on, Sunil.
No, no, I said
No,
so.
no, complete your point.
The transmission of liquidity into the system, right, will be enhanced by
Hmm.
the allocation of money into these categories, because they are ideally tuned to the short-term fluctuations of the repo market.
Got your point. Sunil, one last question. We had some brokerage notes on IT, and we've been talking about IT almost every time we speak. But off late we've seen buying interest in IT. This particular sector has provided support to the market. Some brokerage notes were saying that it'll be a good idea to sell on rise. Would you concur, or would you say that no, keep buying them because going forward, the recovery is expected to kick in case the US markets or US economy doesn't slip into a recession?
Okay, yeah, I am actually right opposite to that view. I say buy on dips rather than sell on rise, because if you take a 6 month, I think the IT index is still hugely underperforming the broader markets, right? Whether it's Nifty or Nifty 500. So clearly, IT has taken a lot of the overhang over the last few months, in terms of the fact of the US going the credit downgrade of the US, and that US companies may not do so well. What are the tariff impact? All that negative is in the price. But the stability of IT in terms of its returns, I think, is a huge positive. And I think the IT rally has been, despite the fact that FIs have not been very strong players in the recent past. So clearly, domestic fund managers are the ones who have reallocated to IT, given the way forward. But when FIs return in a big way, which I expect again, as I said, for me, the BTA signing is the next trigger. When their flows come in, right? When a significant part of those flows tends to be passives and all that, and we should get their share of IT allocation. So I would say that IT will continue to receive
Hmm.
liquidity support, given the fact that over the last 6 months, it's been the worst performing sector. It's only the last week or so that it's been rallying. But over a 6 month, you take the returns, they are for hugely underperforming. So there is still value in the IT pack because that consistency of their earnings, right, will get a premium. So I am of the view that the correction was overdone. We have just started the rally, and I'm not sure that you should be selling on dips. On the contrary, I would continue selling on rises. I would say that you should be actually be waiting for any corrections that happen to accumulate IT, because I see that it is the big FII play that will drive it up further, and rather bet buy before that play fully happens than wait for that to happen.